Markets don't panic when bad news hits the screen. They panic when something important changes quietly, and most people don't notice until it's too late. Right now, the conversation around XRP feels backwards. Prices haven't exploded. Headlines aren't screaming. Social media is split between boredom and disbelief, and that's exactly why this moment matters more than it looks. Most investors are trained to react to outcomes. Professionals watch the plumbing. What's happening beneath the surface isn't about a single rumor, a single approval, or a single price candle. It's about infrastructure decisions that don't move markets overnight, but permanently change how capital is allowed to flow. Here's the uncomfortable truth. By the time the narrative feels obvious, the positioning is already done. Institutions don't wait for clarity headlines. They move when regulatory pathways start forming, even if those pathways are incomplete, conditional, or slow, especially then. So if you're waiting for confirmation before paying attention, you're already late to the process, even if you're early to the price. In the next few minutes, we're not going to speculate. We're not going to hype timelines, and we're definitely not going to pretend we know what Friday brings. Instead, we're going to separate what's confirmed, what's forecasted by credible sources, and why those two things alone are enough to explain why this market feels strangely quiet right now. And once you see that distinction clearly, the price action, or lack of it, starts to make a lot more sense. Over the past several weeks, XRP has traded within a relatively narrow range, with volatility lower than what typically accompanies major narrative shifts. While intraday moves have occurred, none have broken prior structural levels established earlier in the quarter. Compared to last month, price action remains compressed rather than directional. At the same time, market activity beneath the surface has changed in measurable ways. Spot trading volume has increased meaningfully on several sessions, outpacing derivatives volume growth. This matters because spot volume reflects fully funded transactions rather than leveraged positioning. Futures open interest has risen, but not at a pace that suggests excessive speculative buildup. Funding rates have remained largely neutral, indicating balanced positioning between long and short participants. From a timing perspective, these changes have occurred without a corresponding catalyst visible on official regulatory calendars. There have been no formal announcements from U.S. banking regulators confirming approvals, denials, or completed applications related to Ripple's trust banking efforts. Public records still show the process is ongoing. What has changed since last month is the volume of commentary from industry participants and analysts referencing regulatory pathways rather than outcomes. Several market observers have cited expectations, sourced to unnamed contacts, regarding progress on U.S. trust charter approvals. These statements are not confirmations and are not reflected in any published agency decisions. Separately, Ripple Prime continues to report institutional activity consistent with its historical disclosures. The platform has publicly stated that it clears and processes trillions of dollars annually across FX, digital assets, and derivatives for institutional clients. No revisions to those figures have been issued, but recent commentary from executives emphasizes increased interest in regulated stablecoins and tokenized collateral within existing workflows. On the blockchain side, the XRP ledger has seen a documented increase in tokenized real-world assets, particularly short-duration treasury instruments. Public dashboards tracking on-chain issuance show a substantial rise compared to the start of the year. This growth reflects deployments already completed, not proposals or pilots. In summary, compared with last month, price has not accelerated, headlines have not resolved uncertainty, and official approvals have not been issued. What has changed is transaction mix, spot participation, institutional commentary focus, and the scale of on-chain assets already in place. These are observable facts, not interpretations, and they form the baseline for understanding why the market feels quiet despite heightened attention. Most market narratives stop at the headline. That's a mistake. The meaningful shift here isn't whether a specific approval arrives this week or next. It's the sequence of dependencies that has begun to align, and how capital responds to those sequences long before outcomes are finalized. Start with regulation. A U.S. national trust charter, even in conditional form, does not change how XRP works. It doesn't alter block times, throughput, or token supply. What it changes is who is allowed to touch the rails. That distinction matters far more to institutions than to retail traders. The first order effect is eligibility. A trust charter makes a firm eligible to apply for deeper access to the U.S. financial system. It does not grant that access automatically, but it moves the entity out of the unregulated bucket and into a category regulators already understand. That alone reduces friction for counterparties deciding whether they can engage. The second-order effect is balance sheet behavior. Institutions don't deploy capital based on excitement. They deploy based on operational risk, settlement certainty, and regulatory exposure. When those variables improve, even incrementally, internal committees begin adjusting limits, counterparties, and pilot allocations. These decisions don't show up in price immediately. They show up in flows, collateral choices, and volume composition. This is where stablecoins and tokenized collateral enter the picture. FX markets still rely heavily on pre-funding and delayed settlement. That ties up capital and introduces intraday credit risk. A regulated dollar-backed stablecoin combined with tokenized collateral offers a way to reduce both. Not eliminate, reduce. And reduction at scale is enough to change behavior. The institutions impacted first are not retail traders or hedge funds chasing beta. They are prime brokers, FX desks, and asset managers managing liquidity across venues. For them, the question isn't upside. It's whether a system allows faster settlement with lower operational overhead. As these participants adjust, the effects propagate outward. Liquidity improves in specific corridors before it improves broadly. Spot volume tends to rise before leverage follows. Infrastructure usage expands quietly while price remains contained. That sequence often feels unsatisfying to observers. There's no dramatic move, no clean signal, just a growing mismatch between improving mechanics and stagnant prices. But that mismatch is the point. Markets don't reprice when the story becomes compelling. They reprice when enough capital has repositioned that the old price no longer clears. Understanding that cause and effect chain is the difference between reacting to moves and recognizing why they form at all. When markets feel stalled while fundamentals appear to improve, the instinct is to assume something is broken. History suggests a different explanation. This is often what transition periods look like. The closest comparisons are not moments of explosive breakouts, but stretches where infrastructure evolved quietly while price lagged. In prior cycles across multiple asset classes, FX rates, even equities, the critical changes happened before the narrative caught up. Take regulated market access as a general pattern. When new regulatory frameworks or institutional gateways are introduced, the early phase is rarely rewarded by price. Capital doesn't rush in. It tests, it probes, it allocates small, then slightly larger amounts, all while public markets remain unconvinced. What mattered in those periods wasn't the eventual outcome, but the order of events. First came eligibility, then pilot programs, then balance sheet approval. Only later did flows become visible at the macro level. What's important is what didn't happen early on. There was no broad retail enthusiasm. Media coverage stayed fragmented. Price action remained range-bound, sometimes for longer than felt reasonable. That delay created frustration, but it also filtered out emotional positioning. This moment shares that structure. Regulatory pathways are being discussed more seriously than outcomes. Institutions are focusing on settlement mechanics, not token narratives. On-chain utility is expanding without marketing campaigns attached to it. But it's not the same environment. The difference this time is that digital assets are no longer fighting for legitimacy. They are being evaluated for efficiency. That changes the tempo. Instead of ideological resistance, the friction is procedural. Committees, risk models, compliance timelines. Another difference is transparency. On-chain activity now provides visibility into usage long before price responds. That wasn't the case in earlier cycles. Today, utility can grow in plain sight while markets ignore it. History doesn't tell us what happens next. It never does. What it offers is a filter. It reminds us that markets often look least convincing right before they transition from speculation-driven to process-driven behavior. That perspective doesn't predict an outcome. It simply reduces the urge to force one. At this stage, certainty is the wrong tool. Probability is the right one. Rather than asking what will happen, the more useful question is what conditions would need to change for the market to move decisively in either direction. That's how professionals frame risk when outcomes are still unresolved. Below are 3 clean scenarios. None are predictions. Each is conditional. Bull case, structural momentum builds. For strength to continue, several things would need to align. Not dramatically, but persistently. First, regulatory progress would need to remain constructive, even if slow. That doesn't require a headline approval. It requires the absence of setbacks, no rejections, no adverse rulings, no signals that the pathway is being reversed. Second, institutional usage would need to keep expanding quietly. Rising spot volume relative to derivatives, continued growth in tokenized real-world assets, and sustained interest in regulated stablecoins would suggest that infrastructure is being used, not just discussed. Third, broader macro conditions would need to stabilize. Not ease aggressively, just stop tightening. A neutral or declining dollar, contained treasury volatility, and predictable liquidity conditions would lower the hurdle for incremental risk allocation. If those conditions hold, price wouldn't need to surge immediately. The more telling signal would be persistence, higher lows, improving liquidity, and reduced sensitivity to negative headlines. That's how accumulation phases typically express themselves. Base case, compression, and patience. The base case is less exciting and more common. In this scenario, regulatory processes continue at their natural pace. No breakthroughs, no breakdowns. Institutional interest remains, but deployment stays measured. On-chain usage grows, but not fast enough to force repricing. Macro conditions remain mixed. Growth concerns coexist with sticky inflation. Liquidity remains selective. Risk assets drift rather than trend. Under these conditions, price likely stays range-bound. Volatility remains subdued. Sentiment oscillates between boredom and frustration. This is the environment where narratives fragment and attention drifts elsewhere. That's not bullish or bearish. It's stabilizing. For long-term participants, this phase is about observation, not action. For short-term traders, it's often inhospitable. Importantly, this scenario does not invalidate the structural thesis. It simply delays expression. Bear case, the precursor warn, gray, the process breaks. The bear case isn't about price weakness alone. It's about a change in direction. That would require something to break in the sequence. A regulatory setback that closes rather than narrows access. A policy shift that increases uncertainty instead of reducing it. Or a macro shock that forces capital out of risk assets broadly, regardless of fundamentals. Another risk is stagnation disguised as progress. If infrastructure discussions continue without corresponding usage growth, confidence erodes. Institutions are patient, but not indefinitely. In this scenario, price weakness would likely be accompanied by declining spot participation and rising sensitivity to negative news. That combination matters more than the magnitude of any single move. The bear case isn't inevitable, but it exists. Ignoring it is how risk compounds quietly. Professional analysis doesn't choose a side. It assigns weight and stays flexible as conditions evolve. When markets sit in compression, headlines lose their value. Indicators don't. The first thing I watch is the US dollar index, DXY. Not because it predicts crypto, but because it sets the background conditions. A strengthening dollar tightens global liquidity. A stable or weakening dollar lowers the cost of holding risk. I'm not looking for a crash or a surge, just direction and persistence. Short-term spikes don't matter. Trends do. Next are treasury yields, particularly the front end of the curve. Sudden moves in two-year yields tend to reflect shifts in policy expectations. When yields become volatile, institutions pull back. When they stabilize, allocation committees re-engage. Calm rates don't guarantee upside, but unstable rates almost always delay it. Inflation data comes next, especially CPI and PCE. Not the headline number, but the reaction. If inflation prints are absorbed without market stress, that tells me liquidity conditions are becoming more predictable. Predictability is underrated. It's what allows capital to move. Inside the crypto market, I focus on volume quality. Spot volume relative to derivatives matters more than total volume. Rising leverage without spot participation is noise. Funded buying is signal. I also watch whether volume expands during flat price action. That often indicates repositioning rather than speculation. Open interest and positioning matter too, but only in context. Rising open interest with neutral funding suggests balanced participation. Sharp increases with skewed funding suggest crowding. Crowded trades break easily. Finally, I watch liquidity behavior, not price. Are spreads tightening? Are large trades clearing without slippage? These details rarely trend on social media, but they tell you whether infrastructure is being used under real conditions. None of these indicators provide certainty. Together, they provide alignment, or the lack of it. That alignment is what I wait for. Markets don't reward urgency, they reward preparation. Right now, there's nothing here that demands a dramatic reaction. No signal that requires chasing. No confirmation that justifies complacency either. What exists instead is a market in transition, one where structure is improving faster than sentiment. That gap can be uncomfortable. It tests patience. It tempts people to fill uncertainty with conviction. That's usually when mistakes get made. I'm not positioning for headlines. I'm watching processes. I'm not trying to predict timing. I'm paying attention to whether the conditions that allow capital to move are strengthening or weakening. If those conditions improve, price will eventually reflect it. If they don't, capital will stay cautious. And that's information too. This isn't investment advice. It's simply how I'm reading the market right now. Risk management comes first. Patience does the heavy lifting, and long-term thinking keeps emotion out of the decision.